Hi, class. Let's talk receivables, accounts receivable. I'm going to go ahead and share my screen, and we'll jump over to a presentation and extraction of that. We're going to go and do some free writing, and we've seen this charts before. Let's actually go over and talk about accounts receivable as a whole. So why is accounts receivable important? Let's take a look at some of these companies and see what the percentage of their balance sheet, percentage of the assets is actually accounts receivable. Notice John Deere has $3 billion, that's 3,000 million dollars in accounts receivable. I think that's a lot of money. 5.2% of the balance sheet. Callaway Golf has 128 million, but it's 16% of their assets, total assets. Pfizer has $8.2 billion, almost 5% of their assets sitting in accounts receivable. Again, that's money's owed to them by their customers. Abercrombie and Fitch, 93 million, it's 4%. You recall that we looked at the inventory as a percentage of assets. I think we had mentioned that Big Lots was 50% of their balance sheet was inventory. So at 60%, even 5%, billions of dollars in receivables, and you never really expect to collect 100% of your receivables. But you do maintain a separate account for each customer and how much they owe you. And when they pay you, you reduce that from the receivable. We'll see how you don't add that to the sale. So let's take a sale on credit. Notice on July 1, accounts receivable, comp store, and sales. So the income statement is impacted with the sale. The balance sheet is impacted with the receivable. And retained earnings, bottom line, increases by the amount of sales, so we're in balance. We also collected some cash. Notice that the 720 we collected in cash from a different customer from a previous revenue source, a previous sale, we're not affecting the income statement at all. We're increasing cash and we're reducing our accounts receivable. We're debiting cash, crediting AR. What's that mean? We're collecting the sale, but we're not duplicating the sale. We already recorded the sale back like here, debit the receivable, credit the sale when originally RDA was sold. RD Electronics bought some stuff, we sold to them, and that's how it got recorded. So store a credit card. I'm going to skip this for a minute because a credit card comment I want to make is when you look at a credit card, we get a sale on a credit card, it's treated as cash. We don't treat that as a credit sale. We have a credit to sales, but we debit cash for the amount of the dollar amount. Typically, you register 100% here, and you register the expense later on. You make 2 journal entries out of it instead of 1. But here they just did 1, and that's perfectly adequate because you had a 4%. That's how credit cards work. You pay anywhere from 2 to 4% typically on the credit card to the credit card company. Visa, MasterCard, American Express is actually a little more expensive overall. So what happens? You sell $100 worth of stuff, credit card company gets $2 or $3 and you get the rest of it. In this case, it was 4%. You kept 96 cash. So the sale, even though it was on a credit card, was recorded as cash, not receivables. So credit card sales are considered cash sales. It gets processed overnight. Usually the next day you have the monies in your account. Then you have installment sales. Customers owe from credit sales, which payment is required periodically over extended time. There are installment sales and there are leases, which are a little bit different. Usually there's interest associated with an installment sale. Nothing's free. So let's talk about 2 methods of tracking receivables that go bad. We have 2 methods that we're going to look at. We're going to look at something called, I'm going to draw this in a little picture for you and make it a little bit more readable. And we'll do it in red. So we have direct write-off. And we also have the allowance method. One of these is GAAP, and one of these isn't. One of these waits until the customer is found that they're not going to be able to pay. Maybe they're out of town, they moved, left no forwarding address. Maybe you'll never see them again. You also have the allowance method, which tells you that, well, we're going to match the time of sale with the time of when we don't expect to collect. Direct write-off is not GAAP. The GAAP method is our allowance method. We'll say sometimes, and it depends, direct write-off can be used. We'll see that in a few minutes. But we're going to be specifying the allowance method to understand how to work this. But I'm going to use the direct write-off method because if it's not material, for instance, McDonald's. If I know the owner of McDonald's, who's a neighbor, and I have one of my kids have a birthday party, and he's going to bill me $200. He doesn't have too many credit sales. A $200 sale, if I don't pay it, and there's millions of dollars in sales, hopefully, $200 is not a big deal. So materiality-wise, he can use the direct write-off method if for some reason I don't. On the other hand, if you are a major company and usually business to business, and most of your sales are through receivables, and then some big tickets stop, not going to be paid, you definitely need to use the allowance method. So let's see what the direct write-off looks like. Well, as soon as you determine you're not going to get paid 6 months from now, a year from now, somebody goes bankrupt, somebody disappears, you get return mail. At that time, you expense the bad debt and you reduce the receivable. Jay Kent, nowhere to be found. He owed us, or she owed us $520, but we're going to write that off. And then the receivable is reduced and the expense is increased and our net income is reduced by writing this off. If we recover, all of a sudden we get paid. We reinstate the receivable. Okay, we take it out of the expense and put back the receivable, and then we get cash and pay off the receivable. Maybe they said, oh, we've been out of town. We've been on our summer home for 8 months instead of 6, and we were going to pay you, but sorry, we forgot. You reinstate the receivable, and then you generate the payoff on the receivable. That's recovering a bad debt. So direct write-off, expense recognition principle requires expenses to be reported in the same accounting period as the sales they help produce. Well, this is a violation of the direct write-off is a violation of GAAP because you're not matching the sale from 6 months ago or 8 months ago with when you're not going to get it. Materiality constraint permits direct write-off method if results are similar to allowance method. So that $200 McDonald's sale, that's acceptable, and we can use the direct write-off method. But we're going to be learning about we're going to be accruing and using the allowance method. So we have to every month at the end or every year at the end, usually end of a period, estimate total bad debt expense to be realized. And you can only debit bad debt expense at the end of the period. Because what happens is we've got an account, and we're going to go ahead and clear off some of this stuff. We've got an account called receivables. And we also have an account. We have an account called allowance for bad debt. It's a contra asset. So you know about accounts receivable. And then we have a contra asset called allowance for doubtful accounts, called ADA. Not the American with Disabilities Act, but ADA. So we have a credit balance in this account. Our net, called NRV, net realizable value. This is the net we expect to collect in our receivables. Maybe on average, we collect 96% of our receivables. That means on average, 4% we're never going to see. So at the time at the end of the month when we're recording this, we record 4% and make sure our allowance for doubtful accounts equals that 4% amount. And then we'll adjust bad debt expense. If we have any adjustments during the month, we clear the receivable and watch it to allowance for doubtful account, or we receive money, we debit the cash and credit the allowance for doubtful account. And then at the end of the month, we recalculate what our allowance should be and come up with our net realizable value. Okay. Advantage number one, it records estimated bad debt expense in the period when related sales are recorded. So monthly, we do sales, we're going to record what we don't expect to see out of that. It also records receivables on the balance sheet at the estimated amount of cash to be collected. That is our NRV, our net realizable value. That's what we expect to collect out of receivables. Not 100%, but in this case, yeah, 96% is what I said we should probably be able to expect. So record bad debt expense. So they have credit sales of $300,000 during the first year of operations. At the end of the first year, $20,000 of credit sales remain uncollected. Based on the experience of summer business, they estimate $1,500 of its AR would be uncollectible. So after our first period, we say $1,500, we debit the expense and credit the allowance. Notice AR is still 20,000, but we have a credit balance in our allowance account, a contra asset showing up in the balance sheet for $1,500. Our NRV, our net realizable value in this case, is $18,500. So we look at that and say, that almost makes sense. So balance sheet presentation, I'm going to go ahead and have the current assets, receivables, less the allowance for doubtful accounts. And what you usually see on the balance sheet, you just see the 18.5 number. You might see the allowance in the notes to financial statements. But the bottom line is you're going to see that net of the allowance in your accounts. So that's here stated receivables, net of 1,500 allowance for doubtful accounts. Now we need to calculate what we expect our allowance to be at the end of the month. So we're going to go in, we're going to estimate bad debt expense, subtract the previous balance in the allowance account, and we'll have the current bad debt expense. So let's put that in English. So we right now have an allowance account that said $1,500. Okay. ADA. And you go through and you calculate and you say, well, I got a percentage of my receivables. My allowance should end up at 2,000. So you're going to credit ADA 500 to get it there, and debit the bad debt expense. You're going to add 500. You're calculating the difference here, which is what this formula kind of gets you to. Total estimated bad debt expense. That was $2,000. Previous balance in the allowance account. That was $1,500. What is our current bad debt expense? $500. So you debit the bad debt expense and you credit the allowance account to get the allowance account to where it needs to be based on your calculation as a percentage of receivables. And you can review this again if it's not real clear. We can talk more about it on a Thursday night call if you like. So summary of methods. There's a method of doing percentage of sales and not receivables. I'm only worried about the percentage of receivables method. And the other thing that happens during the month is you might find out that write-off, you say, well, somebody went bankrupt. So I need to clear the receivable for $1,000. What do I debit for $1,000? During the month, I debit my allowance for doubtful accounts. And that's going to be affecting my allowance during the month. So it's going to actually debit $1,000. So the ending balance in this case would have been 1,000. Or actually the ending balance would have been 1,500. I would have had $1,000 debit. So I'd have had $500 net in my allowance account. And at the end of the month, I would have had a $1,500. I would put 1,000 here. I would have used $1,500 here to get to 2,000. And that's how I calculate the amount at the end of the month that I'm going to calculate for my bad debt expense. What happens if that $1,000 you wrote off, they come back and they pay it? Well, you reinstate the receivable, the allowance for doubtful accounts, and you reinstate the receivable. And then you record the cash of 1,000, and you clear the receivable itself for 1,000. The net effect of that transaction, if you cut to the chase, notice my receivable cancels out here. I'm going to debit cash for 1,000 during the month when I get some money and they pay me, and I'm going to credit my allowance for doubtful accounts for 1,000. I'm not going to hit bad debt expense during the month. I'm going to hit it at the end of the month with bad debt expense. But during the month, I got some money, or I had a write-off. I got a bankruptcy notice. I found out somebody wasn't going to pay, and I needed to write it off. I wash it out to the allowance account, not to bad debt expense. The only time that bad debt expense is adjusted only never during the month. During the month, everything else washes out to my allowance account. So make sure we're clear on that. So that's going to be the flow. That's what we got to figure out. That's what we're going to handle. So let's talk notes receivable. If I told you we had a 90-day note, So let's go ahead and we're going to start a clean screen here. And we're going to draw a 90-day note. What the heck's a 90-day note? How many months is that? 30, 60, 90? That's 3 months. So if I told you I had a $10,000 note at 6% for 3 months, out of the gate, how much would I get of this? Well, I'd start out by getting $10,000 in cash. And I have a notes payable, $10,000. Thank you very much. That's you borrowing the money. Someone gave you $10,000, they want to get paid 6%. Now, is that 6% a 3-month interest rate or a 12-month interest rate? Can you answer that question for me? I hope you can answer that question for me. That would be a 12-month interest rate. I got cut off. Yep, no, we're there. We're still there. Okay. So we've got a 12-month interest rate as stated. If I told you you had a mortgage and the mortgage was a 4% mortgage. Actually, I'm refinancing right now to a 2.75% mortgage, 15-year mortgage. If I recommend 15 over 30. If I told you that I get 2.75%, is that over 15 years or 30 years or over 1 year? No, that's per year. That's an annual rate. If I said a 5-year car loan, better to get a 3-year car loan. If I said we had a 4% interest rate, is that 4% over the 3 years or is that 4% a year? That would be 4% a year. So the same thing happens and we have a 6% loan. That's 6% a year, not 6% for 3 months. So that's not 24% a year. Everything is always stated in annual interest rates. So how much interest would this be in a year? Well, 60% of 10,000 is 6,000. That'd be $600 for a whole year. But I told you this is a 3-month note. So I've got $150 worth of interest. And that $150 is going to be paid back to the tune of $10,150 at the end of the time period. We're going to go ahead and pay that back. And what's the journal entry going to look like? Well, it was in the current year, the cash going out the door, $10,150. I've got my notes payable being relieved of $10,000, and the balance it, I got $150 in interest expense. Notice it's not $600, it's only $150. That's based on an annual interest rate. So let's go back and take a look at our PowerPoint and see how that looks. So we're here, we sign a promissory note, and there's a stated interest rate, 12%, 1% a month, no matter what the term is. This term happens to say it is for, where's the term on this? Due date, 90 days, so it's a 3-month note. But this is an annual rate of 12%. So make sure you realize that is an annual rate. All right, maturity date, you have to calculate the days, literally how many days in a month. 30 days has September, April, June, and November. All the rest have 31. Or count your knuckles. January, February, March. Actually, I'm going to go full screen on this. I'm going to go, and some of you may not do this. So we're going to go ahead and count knuckles. January 31, February in the valley, 28 or 29. March 31, April 30, May 31, June 30, July 31, knuckle to knuckle, August 31, September 30, October 31, November 30, December 31. If you told somebody about having a May 30 year end or a June 31 year end, you will discredit yourself right away, and so your credibility would be shot. So I'm going to go ahead and go back to our PowerPoint, but you do have to calculate days on that. Interest calculation, principal note, in our case, we had $10,000. Annual interest rate, we had 6%. time expressed in fraction of a year, so 3/12, a quarter of that, 600, a quarter of that would have been the 300 interest calculated. One other thing or other variable is calculated for purposes of the number of days in a year. Finance folks like a 360-day year. We do 365 for days inventory, days receivable. We believe there's 365 days. But if you're doing a finance calculation, 90 days is 3 months, is 1/4 of a year. Not worrying about the extra leap days or 365 days. So you divide that by 4, you get an extra day and a quarter out of the deal. Don't worry about it. 90 days in a year, so using the 90 out of the 360. 180 out of 360, half a year. 270 out of 360, that's a 9-month note. A 30 out of 360, 1-month note. So those are a way they calculate and the way they figure things. How do you record it? Well, if we have a note for sales, we debit the notes and credit the sales. Or that's what we get. We have a receivable. Or if you're giving cash, you pull cash out and you give cash back. This is past due accounts due. I'm not going to worry too much about that. Principal and interest are due. We just did that. Similar numbers. That was a bit of years of interest in our $600 note, paid out cash of $615. And this is the giver of the note, not the receiver of the money. So in this case, you're getting your money back. You're getting $600 plus interest back from whoever you issued the note to. You gave them $600 originally. They're giving you $600 back plus $15 interest. This is a 60-day note in this case. End of period adjustment. We'll have journal entries to adjust. We have to, let's say that 90-day note went from December 1st through February 28th, roughly. So that would be a 90-day note. We have to record interest expense in for December, debit the expense, and make the adjustment and credit the interest payable. Or in this case, as a receivable, debit the receivable and credit the revenue. This again is the grantor of the note. It gives you the money. So they're owed this money, but no bill was ever sent. That's why you're accruing for it and adjusting for it. End of period interest adjustments. Once the note is paid, the only amount of interest revenue recognized or interest expense is from the current year, not the previous year. This was February 14th. The whole cash amount was paid. We had accrued $15 from December last year, and now we've got $45 in this year's interest and $33,000 to clear the note that was owed, that monies we were owed. So we're the seller, we gave the money, now we're getting it back. Flip this over and you'd have what the actual receiver of the monies did in return. Disposal of receivables. And one thing I want to talk about is factoring. Receivables have a value. You can actually sell your receivables. You can say, you know what? I've got these monies. I'm going to give it. I need the money today, but you're not supposed to pay me for 90 days. I can sell those receivables to somebody who'll give me the cash today at a discount. They won't give me the full amount. So, but I can make money and pay my payroll. I can't pay my employees with receivables. I can't pay my rent with receivables. I can't pay my suppliers with receivables. I need the cash. So I might have to go ahead and get issued that. I might just have to factor my receivables, sell my receivables, sign over rights. Last thing we'll talk about is the receivable turnover. We've got net sales for the year over our average accounts receivable. And remember, when we have an income statement and a balance sheet item in our ratios, the income statements for a year, we have to take an average AR. So we look here and say, what's our inventory, our receivable turnover for Visa? I'm sorry, let's see, 16.9. It used to be 16. It's accelerating faster. MasterCard is slowing down. Okay, so that gives you an idea of how the receivable turnover works. And we'll talk more about when we get, and let's see, we're going to do 5, 6. So we do 1 through 4. Now we're doing 5, 6, and 7. We're going to jump to 13, which is the ratio chapter, and jump to the chase. So that we're going to jump that because that's where your final project is going to be based on. So I want to have that early in your 3rd week so you'll make it aware. So you have 2 weeks to digest the ratios, digest the financial analysis. So by our 5th week, when you don't have a lot of homework due, and you just have your projects due, you'll have a chance to understand and internalize what all those ratios mean. That being said, I have completed what I want to get across in this chapter. Again, available for questions if need be. I thank you for your time.